Hello, everyone, and welcome to the RealAlt Investments live event hosted by Six. We're joined today by the company's president and CEO, Brian Dorr, for a half-hour event with us. So thanks a lot for joining us, Brian. To kick things off, I wanted to ask something for those new to the RealAlt story. So when you think real estate investing, you might typically think about things like rental properties or flipping homes. So what would you say to investors in terms of why the RealAlt approach can be more lucrative?
Well, first of all, we're a niche that focuses on land development for residential use and also construction. So we're targeting specifically a very undersupplied part of the market. And through our Series A, we're actually getting, a lot of first mortgages. So we're actually a secured credit, which means we actually rank above the equity in every transaction we do. So the returns that we're getting compared to, let's say, the development risk, this is a good risk-adjusted return, and it's served us well for the last 12 years.
Yeah, perfect. Thanks. And now, we had a great introduction to you last week by Peter Friedman. So can you tell us a little bit about your background and a little bit more and how you launched your two companies?
Sure. Well, I'll start with my background. I started my career in the early 90s, over 30 years ago. I started in default management and real estate at CMHC, which was a great way to learn. It was tough times in the 90s, and I had to manage many units of distressed assets. Fortunately, we were able to work through that, and it was a great experience. CMAC in general was a great experience. I completed much of my education there. I got my accounting, I'm a certified property manager, and I also got my MBA there. So they were a very great place to be. I spent 10 years there. It was a great learning experience. Then I went from CMHC to Canada ICI. That's where I learned brokerage and more commercial lending in general, like office, retail, hotel. And then I went to Quest. Quest was more of a private shop. We did a lot of private money, a lot of mezzanine lending. Then 2008 happened, and I switched back to working for the government. I worked for the government of Ontario, Infrastructure Ontario. At Infrastructure Ontario, I set up their lending program. I set up all their security. I set up everything. I set up the credit committee. Great learning experience working there. Then I went on to Cameron Stevens, where I guess rounded out my experience in the residential market. And from there, I figured it was time to go on my own. And that's when I started Dorr Capital. And then about 5 years after, or 6 years after Dorr Capital, we started working on bringing RealAlt to market.
Great.
Yeah.
And what were some of the big learning moments for you throughout that time period?
Well, I'd say CMAC gave me a foundation, solid foundation. Canada ICI, MCAP, CDPQ, that's where I started to really understand the industry stakeholders and actually learn how to run a business. And that's where I built my network. Quest taught me how to work with private money and private investors, higher risk loans. Infrastructure Ontario sort of opened my eyes to the limits of what the government can really do for the real estate market. So it was a very interesting experience. And Cameron Stevens taught me, that I was ready to go on my own. And then when I launched Dorr Capital, that taught me I knew nothing. Starting your own business is just a whole other experience. And now I just learn every day.
And Dorr Capital has been in business for 12 years. So why did you start the business? And just tell us a little bit more about that.
Well, coming out of the financial crisis, one of the things that had happened is there was a big pullback of lending to the land, well, in general, but specifically the land, residential and construction space. A major gap was created. Our premise was really just to fill that gap, and that's what we went on to do. We saw that this had a bigger impact on medium-sized developers, so we ended up targeting that group, and it's worked out well.
Mm-hmm. And what area of commercial real estate do you operate in?
So Dorr Capital itself, we can operate in many areas. We know how to underwrite real estate in industrial, retail, office, multifamily, land, residential construction, condo, hotel, retirements, self-storage. You name an asset, we know how to underwrite it. We have chosen to specialize in land and residential development because that is the most undersupplied part of the market and continues to be. We focus on land servicing, and construction. And land servicing is, for those who don't know, that's like the infrastructure, like water, sewer, gas, electrical infrastructure to each property. And we've also spent years and years perfecting our underwriting models for these particular assets, and we continuously adjust for market. And the other thing we've done is we've spent a ton of money on our IT infrastructure to ensure security of our data and our investors' data and our stakeholders' data. There you can see our underwriting process, the basic 5 C's of credit. We will be having a further discussion on another topic with another panel with my head of underwriting to walk everybody through all that process in more detail.
Yeah, and can you share some results with us around that?
Sure. Since inception, we've worked on about $2.5 billion worth of transactions. Our assets under management are approximately $230 million. We have loans close to $430 million in 2022. Average loan size about $13.9 million or $14 million.
Mm-hmm. And why did you launch RealAlt Investments?
Well, we've been working on, as you can see, these are pretty large volumes. Most of our investors have been traditionally ultra high net worth or institutional investors. We had the premise of trying to democratize this and have so that that everybody can invest the same way as our institutional investors invest, and that was our premise for creating RealAlt. We also chose a space that is and our chosen space was land, residential land, and that's also in very, very short supply. Notwithstanding what's going on in the current market, I mean, it's still in short supply. We're hearing in the news every day, but it's not changing soon.
Yeah, no, you definitely hear a lot of stories about that. And last week, Peter gave us an overview of the economics and in Canada, but there seems to be daily updates or announcements about housing. So why is that?
Well, as a Canadian, I guess, and I'm sure most of the people here are, I think it's one of the number one things that outside of the province of Quebec, most people have a high propensity to want to own a home as their main investment and their place to live. That may change over time, but that's traditionally how it's a high value item for most Canadians. Also, it's a great place because we don't have to pay capital gains, and you hold your wealth and it grows well. I don't see this changing. So it's very, very important to people. Also, when you increase interest rates 280%, and it really has a huge impact, and you're seeing that people can't afford to buy houses at the moment. This is a crisis it's a crisis on a crisis, because we already had a shortage of supply, which probably helped contribute to the highest, run up of inflation. But now what's happening is there's now no construction. So the opportunities are getting actually better from a real alt perspective, because we're getting better risk adjusted returns. But we're going to have a huge boom coming out of this, because there's going to be pent up demand.
Yeah, and I was going to ask, how does the Canadian economy affect your business? Just expand on that.
Yeah, it's been a rough year, in the sense of I'm seeing a lot more distressed assets, but we have some strong clients. They're doing well. They're closing deals, but it's slowed. What I see is opportunity coming around the corner. So we're in a bit of a once in a 25-year cycle of real estate. And this is a great opportunity we're going to launch a new series within our fund called Series M. And that's going to be, we're going to be looking at distressed assets. So if you look at our RealAlt Series A, we're targeting anywhere between 8 to 12% returns on generally first mortgages. What we're doing in our Series M is we're going to look for distressed assets, which I think is going to be a big thing next year. And we're going to be looking to buy discounts on either property through equity or discount mortgages, and there's a lot of creative things that can happen. And that goes back to my background at CMHC. I have lots of background in working in default and workouts and things. So it's going to be a very creative time. It's well suited to my skill set. So we're launching a fund, or not a fund, a series that will hopefully exploit this. We're looking for returns in the neighborhood of 15 to 30%, depending on what we're into.
Wow, nice. And to follow up on what Peter mentioned last call, so he mentioned something about baptism by fire. So what was that experience at CMHC, and what did you learn from that?
Yeah, so it's a very interesting experience. So I just gotten out of university. I just finished my my degree, and I also I went to a Laurier for accounting, and I hadn't quite had my designation yet, but we were put in a small team of similar individuals. It was about 4 or 5 of us, and we had to work out at least 100 projects. And we did this. We created about 100 business plans in about 3 months. We had no idea what we were doing, or so we thought, but we ended up with creating the framework for CMHC to work out most of its assets, and it was super successful. And as Peter pointed out, we recovered 98% of whatever the outstanding capital was. We did have time, and it sort of proved the point. There was also a lot of people who made a lot of money in the partners we had taking this stuff out. I know that some people did extremely well after that, because after that the values just shot up. So there was people that were buying all these assets. They did far better than CMHC did. So, but even though we got out, so it was a incredible time to learn. Had a ton of responsibility at a young age, and there's really no one younger than me that has that experience. So if you think about that, I've got 30 years of business experience. This is the last time somebody's seen something like this. So again, while I'm excited to launch this new opportunity distressed asset fund. So.
Mm-hmm. And what are you finding? What opportunities are you finding in the market right now? And can you be very specific about them?
Okay, so like our traditional stuff, we're seeing we're getting great first mortgage opportunities. We were hitting returns, and if we're a little riskier, we were kind of like 6 times the risk-free rate to get 12%. Now we're getting we're getting similar opportunities at lower loan to values, but we're still getting the same rates that we want, right? So it's good. Our first mortgages are going to be really safe. And if you think about the values right now, land is a residual value. So if the housing prices come down, that actually lowers the value of land. So that's the prices we're going in at right now. So we're going in at relatively low loan to values, at low value valuations in general. So Series A is looking good. And then on the spicier side, we see developments that need workouts, where we can inject money, maybe in a mezzanine position or an equity position, partner with builders that are really good and buy a distressed asset, which look like they're going to have outstanding returns in incredible locations. So,
okay, yeah, excellent. And a little bit of a clarification question here. So, for those that may be confused about this, could you please clarify what the difference is between a mutual fund trust and a mortgage investment corporation, or MIC?
Yeah. So, okay. So MIC is an entity that was created in the 70s. It's a mortgage investment corporation that they invest in mortgages similar to us. They're a tax flow through. They're RSP eligible, similar to what we do, but they are restricted in the allocation of assets. So, for instance, they probably could not exploit a distressed asset opportunity. That would not be something that would be within their mandate. Whereas we're in a mutual fund trust, it allows us more flexibility to just specialize in land. MICs have to invest at least half their portfolio in residential houses or residential mortgages. So it's a different business. So they end up having to do commercial business and residential mortgages, which is fine. But they're very different businesses. I've actually worked on residential houses, but it's very different business. So we get to specialize in what we're good at because we don't have that same restriction. We have all the advantage of being a tax flow through. You can, registered accounts. So we have all the same tax advantages. It's more flexible for us.
Mm-hmm. Yeah, perfect. So thanks for taking us through that presentation. What I'm going to do, we've got a number of questions. So what I'm going to do is I'm just going to go in order
Sure.
and jump right in here. So PT Harris asks here, and he's saying that this is her first event. He missed the last one. So is investing in real alts closer to investing in growth or value stocks, or does it follow the real estate market closely?
Okay, so as of the later, once I launch Series M, it might be a little bit of both. But traditionally, our Series A is a fixed income alternative. It offers excellent risk-adjusted returns. We're target anywhere between 8 to 12%. So and they should be consistent monthly pay, and that that's what we're offering there. Whereas when I launch Series M, that will be a little bit more like a growth opportunity for sure, because we're looking at 15 to 30%. I think the liquidity will be a bit harder. It won't be as liquid, but it will offer excellent returns in return for illiquidity.
Mm-hmm. And another question here, but this one from Henry. Is there a buy-in minimum?
Yes. If you ask me what it is, I don't know. I think it's like 25,000. I think it's something like that, but I have to double check that.
Okay. Yeah, Henry will get back to you on that question. And another question from Henry here. Why do you choose land and construction? Also a huge percentage in land, in brackets Series A. Why do you like that niche so much?
Well, I like the niche for the same reason. So that you see in the papers. So we're talking about a housing crisis. Well, you need land to build houses, and they're not talking about building houses on existing houses. They're talking about building houses on new land or redevelopment potential. And let's say if it's a downtown infill site, they're converting it to a different use. So it is all about land at the end of the day. I've worked in all asset classes in real estate, and I think it seems like land is the basic thing, but it actually is the most evolved state. So when we look at a piece of land, we do a model that figures out what it is in the end, and then we work backwards. So to me, it's the most exciting thing. I think it's where all the money's made, actually, in real estate, is on the land side.
Mm-hmm. Great answer. Yeah. And another one here from PT Harris. Why would I invest now and not wait a bit to see what happens / de-risk? I'm guessing that's relating to the economy and.
Yeah, that's a fantastic question. And being a guy that's in this market, I can understand that question. So it boils down to, be fearful when people are greedy and be greedy when people are fearful. There is definitely a lot of fear in the market. I'm seeing it in terms of how valuations are going and how the land is trading right now. And knowing what I know, because I've been in the market for 30 years, I know it's going to come back. So now is the right time. Like especially next year, coming into next year, it's the right time to be part of that. There may be some bumps, but you know what? We're okay with the bumps. That's how we'll make more money. So that's how I'd respond to that.
Okay, perfect. So that's it for the questions that we have here. So what I want to do is just thank you for taking the time to go through this presentation with us, Brian, and sharing the experience. Do you have any closing remarks that you'd like to give?
Well, I just stay tuned for our next presentation. If you're interested, please reach out. We'd be happy to talk to you.
Yeah, fantastic. And thanks everyone for joining and for asking the questions. And we'll be sure to inform everyone of the next event. Thanks, Brian.
Thank you.